Well, good afternoon and welcome to HiRock's weekly webinar where we are going to talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. Now, we invest our money in the exact same models as our clients, and we think that this is really important. We call it eating our own cooking. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson, and I'm joined by my partner and colleague Paul Tepsich, the founder of HiRock, who, by the way, has done some wonderful bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year, continuing to add value to our models and portfolios while at the same time reducing our exposure to risk. Our financial planner and wealth forecast specialist, Bianca Tomlinson, is also on the call, and we will have a question and answer period at the end of the call, so if anyone on the call has a question about any aspect of how we manage wealth, we invite you to feel free to ask us questions. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, as we do for each webinar, let's quickly recap our themes for 2016 before we get started on what happened since we last talked. As you all well know by now, our overriding theme for 2016 is that financial markets will remain volatile, and we expect that to increase as we get closer to the U.S. election. The U.S. economy contributes approximately 20% of the global economy. The risk of a recession in the U.S., we think, is high and rising. Low inflation and deflationary pressures continue on a global scale despite the efforts of central banks to mitigate them. And extraordinarily stimulative central bank monetary policy on its own has not succeeded in reigniting economic growth, and now central banks are revisiting their options. First, Brexit and the rise of populism in developed nations, and now with the U.S. presidential election, there is a concerted pushback against globalization and freer trade. Throw in the terrorist threat and racial tension, and the sum of it all is having an impact on the consumer, business, and investor psychology. Bond markets have concluded that central bank policies are suggesting higher concern for the global economy, and yields have once again dropped. Equity market prices do not truly reflect the underlying fundamentals, and possibly 6 consecutive quarters of negative annualized earnings growth. And we are in a time when the risk-free rate of return is basically at 0%. Well, inflation, depending on your circumstances, is at or about 2%. So the math suggests that to get better than inflation growth with your money, you need to take risk. The question is how much and what kind of risk. We think that investors are taking on too much risk relative to their potential returns. Well, let's have a look at what's been driving markets over the last week. As we had anticipated, volatility has returned. We don't think that it is going away anytime soon. And this is how volatility looks relative to recessions in the U.S. It certainly does get elevated, but that is probably no surprise. With higher uncertainty comes more fear, and the Fear and Greed Index is a little bit lower than it was at this time last week. And we think that there might be more fear to come. Well, since our last webinar, our benchmark World Equity Index is better by about 1.25% and up by about 5.5% on the year. The Australian All Ordinaries Index was the best performer on the week. China's Shanghai Composite Index was the worst performer. The Canadian TSX has been the best performing country index in the developed world this year. China's Shanghai Composite Index has been the worst performing index. The Broad and Diversified Benchmark Equity Index, upon which we gauge the performance of our global equity model performance, covers close to 2,500 companies domiciled in 23 developed countries and 23 developing countries, and covers 10 economic sectors. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. Well, after the U.S. Fed left rates unchanged, our benchmark equity index jumped, but was unable to see any follow-through buying to take it above the top of the current downtrend channel. Now, there's a longer-term uptrend channel joining the lows from 2011 and the lows from earlier this year that puts the shorter-term downtrend channel in the middle of the longer-term trend range. Now, that may need to be watched closely for developments of either buying support or selling resistance, and so we shall watch closely for the next technical situation to evolve. Needless to say, there has been plenty of volatility since the peak in May of 2015. The year-to-date return for the All-Country World Index is 6.37%. The one-year return, 11%, and that is because there has, if we look back a year ago, we see pretty low levels, and that's the jump that we've seen. 3-year return is just a little under 5%. The 5-year return around 10%. If we combine the equity and bond indices into a balanced scenario and allow for fees and MER costs, the total return for a 60% equity and 40% bond index combination year to date is about 5%. The 1-year performance just a little under 8%. The 3-year performance around 4%, and the 5-year performance around 6.5%. Now, a less risk-oriented 40% equity and 60% fixed income portfolio after fees and costs year to date is 383. 1 year just a little over 7%, 3 years about 4.25, and 5 years about 5.25. By comparison, a client who started with us in January has a total return this year to date after fees and costs of 6.67%, nicely ahead of the benchmark, which comes in at just a little over 5%. Volatility over the last couple of weeks has eroded the year-to-date performance of the benchmark significantly, but the HIROC client portfolio has remained relatively stable because we take significantly less risk in our models and our portfolios while attaining better risk-adjusted returns. After fees and costs, a 1-year performance of a 60-40 HIROC client is 763 return compared to the benchmark just a little under 8%, reflecting the volatility of 1 year ago. The 3-year performance of 797 is well ahead of the just a little over 4% 3-year benchmark. Now, I must also remind all of our listeners that, and as I do each week, historical returns are in no way a guarantee of future returns, although at HIROC we work very diligently to try to get the very best possible risk-adjusted returns for our clients and ourselves at all times. Fixed income prices were all higher, led by U.S. bond indices this week. Last week we talked about the HIROC Canadian High Yield Bond Fund that we manage in our institutional division and the difference between the actual trading price and the net asset value. The same listener asked if we might show the total return of that particular fund this year to date, which on a daily basis from December 31st of 2015, according to Bloomberg, has had a 16% plus total return. Comparatively, the Canadian Preferred Share Index ETF has had a 1.38% total return. So as proxy for Canadian high yield, it has definitely outperformed on that basis. And as always, this is not intended to be a recommendation to buy or sell any of these securities, but is being used strictly for comparison purposes. In the world of commodities, oil was a little higher this week and has been able to remain in the uptrend channel that began with February's lows. Now, the U.S. represents, as I said, more than 20% of the global economy, and with over 50% of the companies in our benchmark index domiciled in the U.S., we keep a close eye on what's going on in the U.S. economy. almost 70% of the U.S. economy dependent on the consumer, it is certainly important for the consumer to be confident. When consumers are not confident, they will postpone spending. When businesses are uncertain, they will postpone investing. This makes it a tough environment for economic growth, which in turn makes it difficult for corporate earnings to grow. While the U.S. presidential election is one of those factors causing lots of uncertainty and will likely cause more as we approach Election Day on Tuesday, November the 8th, for the moment, Clinton has a slight edge over Trump. Now, these polls do not include any post-debate polls, so it'll certainly be interesting to see how they adjust after the debate. And as I mentioned in my blog this morning, I was not particularly impressed by what I witnessed in last night's debate, so I cannot see how it might change any undecided voters' minds. What it leaves me with is the ongoing uncertainty as to what the political agenda will be in 2017. With that, I am not sure how consumers and businesses can make any important economic decisions with confidence and see the natural path as one of wait and see, which postpones those decisions and potentially reduces economic growth. Well, in their decision and press release last Wednesday, the U.S. Federal Reserve suggested that they expected economic activity to expand at a moderate pace and that the case for an interest rate increase had strengthened. But at the same time, they reduced their expectations for economic growth once again for 2016, as well as increased their expectations for unemployment. So that's very mixed. And by now, you all know what we think of the stalling unemployment levels relative to the rapidly declining 3-year moving average and its historical significance in predicting the timing of recessions. The Fed needs to show their positive side to the general populace by keeping an optimistic tone. However, there is obvious concern behind the scenes. After the Fed's decision, the yield curve flattened, which tells us that bond markets are also not convinced about U.S. economic growth, and you know, as we have often told you, that bond markets do lead other financial markets. And as we pointed out before, historically, when yield curves flatten, recessions tend to follow. Meanwhile, third quarter GDP estimates continue to decline as the consumer has pulled back on spending. And elsewhere in the global economy, Brexit rhetoric continues, with the ECB's President Mario Draghi becoming the latest European official to push for the European Union to take a tough line in negotiations with the UK, saying that Britain should be refused access to the single market unless it sticks to rules on free movement of labor. And the pound continues to trade below the 130 level versus the US dollar. Now, 2 weeks ago, the Bank of England kept interest rates and monetary policy steady, but also said that a majority of members would support a further rate cut in November if the outlook at that time is consistent with the August inflation report projections. Well, ECB President Draghi told the European Parliamentary Committee in Brussels yesterday that in our economic and monetary union, in particular the economic governance framework, is essential to avoid imbalances that would eventually risk destabilizing the euro area and for the euro area to thrive. Actions by national governments are needed to unleash growth, reduce unemployment, and empower individuals while offering essential protections for the most vulnerable. In essence, Draghi is stating that European central bank monetary policy has done most of what it can, and it is now up to the euro area countries to act to stimulate growth. Well, the Bank of Japan left the interest rate unchanged at negative 0.1% at last week's meeting, but said it would introduce yield curve control to hasten its fight against deflation. The bank will guard short-term and long-term rates and vow an inflation overshooting commitment in which the bank commits itself to expanding the monetary base until the year-on-year rate of increase in the consumer price index exceeds the price's stability target of 2%. and stays above the target in a stable manner. Now, the Bank of Japan wishes to manipulate the yield curve to keep short-term yields low and longer-term yields higher. In essence, this is a move to keep the yield curve positive. As we have stated many times, a flat or inverted yield curve tends to lead to a recession. The bond market had previously built this in, and last week's announcement did not change the curve in any significant fashion. It is clear that the Bank of Japan is running out of ideas. Well, inflation in Canada was higher by only 1.1% in August, and depending on your perspective, this can be both good and bad news. On a macro level, it means that the Canadian economy is not growing fast enough to generate the Bank of Canada's targeted levels of inflation. But at your personal level, it means that your cost of living may also be growing at a lower pace than we have assumed in your wealth forecast. Now, as we always say, each individual and family will have their own level of inflation based on where they live and what they consume. If you consume more alcohol and tobacco, for example, your cost of living will likely be higher than someone who doesn't. Now, if you own a car and drive to the cottage every weekend, your cost of living looks to be diminishing ever so slightly. What is important is that if you are generating 4% annually in returns after fees and taxes, and your inflation level is only at or about 2% versus our assumed 2.5%, then you're getting a real after-inflation growth by an extra 0.5% over and above your target in your wealth forecast. Well, that is a good thing. The next step then is to review your risk appetite. Can you reduce risk if you are in need of less growth? Well, that's what our wealth forecasts are all about, determining what is the appropriate portfolio strategy consistent with your goals. And as our clients all well know, we want to make sure that we're reviewing those goals with you at least every 6 months. So if your time is coming soon for a review, we will be in touch. Well, consumer prices in China rose 1.3% year-on-year in August of 2016 compared to a 1.8% rise in July, while the market expected a 1.7% increase. It was the lowest inflation rate since October of 2015. So where do we see all of this taking us? Well, as we said, bond markets do tend to lead other financial markets. We've looked at the Japanese and the U.S. curves already. We noticed that in sympathy, the UK curve also flattened, signaling weaker economic expectations. The Euro-German curve also flattened, with negative yields moving out close to the 15-year maturity mark. And with lower inflation and all the other curves shifting flatter, so too did the Canadian curve. All in all, generally not a positive window on the global economy. Well, as for equity market value, we continue to stress the fundamentals for stocks do not look good. This year alone, earnings growth for the year has been revised from an expected rate of growth of 6% at the beginning of the year to a negative 0.3% at this particular time. However, the S&P 500 stock prices have risen by close to 5%. Third quarter earnings are expected to continue the negative growth for a sixth consecutive quarter. So why are stock prices so high? Well, two reasons really. One, because investors are taking on greater risk as they chase higher potential returns, opting for better yields from dividends than from safer assets. Secondly, analysts are predicting a rather optimistic 13.1% growth rate in earnings for 2017. While analysts had difficulty forecasting 2015 and 2016 earnings growth, their 2017 forecast may be a little suspect given the outlook for economic growth. Well, why are earnings important? Well, because they are the fundamental reason for buying stocks. When investors buy stocks, they buy a stream of future earnings which go to pay dividends or are reinvested in the company. The price-to-earnings ratio represents one metric to measure stock prices relative to earnings. The 10-year average price-to-earnings ratio is 14.3 times. The 12-month forward price-to-earnings ratio, which incorporates those analyst forecasts for future earnings, is currently at 16.8 times. That difference is what makes stocks expensive. We prefer to buy equity assets when they represent more reasonable value at or better than the long-term averages. Well, what does it all mean? As I said last week and previous weeks, for over a year now, we've taken a cautious and defensive posture to investing, but that does not mean we are not investing. We are utilizing our skills to ensure that our client and our portfolios are invested to achieve the best possible risk-adjusted returns. It is clear that we've been able to not only capture growth, but keep it in times of higher volatility through the course of this year. Well, part of the success of our year-to-date returns comes from what we have been able to achieve partly in our tactical model. And as per usual, I'm going to ask Paul if he's got anything to add to this week's commentary.
Thanks, Scott. There's not a lot of changes in the portfolios across the week. We did add one small new issue in fixed income late last week in Air Canada. That was a refinanced bond. So they called one bond we owned and issued a new bond with a lower coupon, mind you. Actually, that's pretty good for Air Canada stock, which unfortunately we'd sold a little bit of the week before. I may look actually to buy that back. Air Canada is going to save substantial interest expense with a pile of these refinancings. Away from that, I'm working on one project. I'm still looking at that other credit, company I've been looking at for a while. And I guess just to add, the markets certainly yesterday, and I think there's a bit of fear today in the markets, although U.S. stock markets are obviously up on the day. We've seen some fear through Deutsche Bank and some other European lenders, but that certainly came through yesterday. I wrote a blog on that, in fact. So I think that is worth keeping an eye on, but it's not something I certainly don't spend time doing work on any bank, to be honest. Something to watch. Anyway, that's all I have for today. Sorry.
Thanks, Paul. That's great. Appreciate it. As we do, let's have a look at what's coming down the pipe. So tomorrow we're going to see some economic data out of the U.S. as well as hear Chair Yellen's testimony. Then on Thursday, a whole slew of data out of Europe, the business confidence index. We're going to see the final, even though it's relatively old, data for the second quarter U.S. GDP. Then some consumer confidence data from the U.K., Japanese inflation and unemployment, and I'll look at what's happening or what has happened in September in manufacturing and in China. On Friday, we'll see European unemployment data. The next Monday, we'll get a look at what's happening with manufacturing in the U.S. Tuesday, we'll see some consumer confidence data out of Japan. Of course, we'll have our HighRock client webinar. Then on Wednesday, we'll see non-manufacturing data out of the U.S. And then, as we most should know by now, our HighRock Capital Management client event takes place on Wednesday evening from 7 till 9. We look forward to seeing all our clients, our friends, and some of our clients and guests at that. Friday is the employment data in North America, both Canada and the United States. So, of course, that will be relatively important, but that will all take place, of course, next week. And as I mentioned, we will be having our client event on Wednesday, October the 5th. So if you have not RSVP'd, we would certainly appreciate getting a handle on numbers. We do have very limited space at this particular point in time, but certainly room for a few more. Well, that's it for today, and if there are any questions, this would be the time to bring them forward. All right, nothing for today. But if you are listening, and as you have each of the past few weeks, please feel free to send questions, email them to me or Paul, and we certainly appreciate all the feedback that we get on these calls. As always, Thank you for taking the time out of your busy schedule to tune in. Don't forget to tune back next week. And until then, this is Scott Tomlinson signing off.